Hi friends, in present video I am going to explain about the advantages of index funds. First advantage is low expense ratio. So the biggest attraction of an index fund over one actively managed fund is its lower expense ratio. While an actively managed fund may charge you between 1% to 2.5%, one index fund would typically charge you between 0.2% to 1%. For example, one investor, Ravi, wants to invest 1 lakh rupees in one actively managed fund at 10 rupees per unit NAV, bearing an expense ratio of 2%. If by the end of the year the NAV has generated 12% returns, then on his investment, how much returns he is going to get? 1 lakh rupees plus 12% of 1 lakh. Finally, 1 lakh 12,000 rupees. So if you deduct 2% expense ratio from these returns, then finally this fund is generating 1,09,760 returns. In case of index fund, if a same amount is invested at the same NAV and if this NAV has given the same returns at the end of the year, then from the returns 1,12,000 you have to deduct expense ratio. No? In case of index fund house, asset management company charges lower expense ratio. So if expense ratio is 0.5%, then 0.5% of 1,12,000 becomes 560 rupees. If you subtract that amount, finally an investor can get a return of 1,11,440. So comparatively, in index fund, return is more because of lower expense ratio. How an AMC is able to offer one index fund at a lower expense ratio? There are two reasons for that. So let us see those reasons. These two causes allow AMC to charge lower expense ratio. First reason is low operating cost. For example, one asset management company launched index fund scheme which is tracking one market index Nifty 50. Now the main job of fund manager is to replicate the portfolio of Nifty 50. Therefore, he doesn't take the services of research analysts while picking the stocks. Even he doesn't put his efforts, his expertise while designing the portfolio. His job is simply to copy the portfolio of market index. Therefore, AMC need not to pay much professional charges to fund manager. Then second reason is lower turnovers. Here turnover means the trading of portfolio stocks. Trading means buying and selling. When fund manager is buying or selling the stocks of fund portfolio, he has to pay transaction cost. Similarly, when stocks of portfolio are sold on capital gains, AMC has to pay tax to the government. These taxes are finally passed on to investors. Comparing to actively managed funds, you can see lower turnovers in case of index fund. So because of these two reasons, AMC can offer one index fund to investors at a lower expense ratio. Let us see the second advantage. Steady returns in long term. Suppose you are working as a manager of one marketing department. You need one salesman. So 3 members, Ravi, Murali, Gopi, applied for the job. You want to test their marketing skills for 2 days. First day they went to field with your company products. Ravi sold 11, Murali sold 7 products and Gopi sold 2. So evening everybody praised Ravi. You also felt that he is the correct candidate for your company. He felt happy. Second day, Ravi sold 1, Murali sold 7 and Gopi sold 9 products. So on second day everybody recognized Gopi. Observe one point, on these 2 days nobody noticed Murali. But if you observe the total sales of these members, Ravi sold 12 products, Murali sold 14 and Gopi sold 11. So finally it is advisable to take Murali because there is a consistency in his work. Here the performance of Ravi and Gopi can be compared with actively managed funds. Either they give windfall gains like 11 and 9, or they totally fail to generate returns like 1 and 2. But Murali's performance can be compared with one index fund. So it is known for its stability. The predominant feature of index fund is its reliability. This index fund is tracking Nifty 50, no? So these 50 companies are proven companies and financially sound companies. Therefore, even though market falls, in other words, during bear markets, you cannot see much decrease in the market price of this company stocks. As a result of that, you cannot see much decrease in NAV of index fund units. Thus, these funds are less volatile. Even though there is a loss will not be too high. This is 2020, no? If you observe the returns of good Indian actively managed funds over 5 to 10 years period, you can notice 3 to 5% excess when compared with the returns of index funds. Index funds are popular in developed countries like UK, US, Switzerland, Singapore. But in our country, in developing country, for a short-term period, active funds are able to beat the benchmark returns. So for short-term period, index funds are not advisable in India because in short period, the fluctuations in market index may adversely affect the returns of index fund. But index funds are always advisable for long period. Here long period means 15 years to 20 years period, because in long period no actively managed fund can beat the benchmark index. In long period, index funds give guaranteed returns to the fund investors, because when you are investing in index fund, it gives the meaning that you are directly investing in Indian economy. If a market index is totally crashed, if Indian economy is totally collapsed, if all Indian companies will come to an end, when banks are unable to repay your fixed deposits, then only you will get complete losses in index funds, which is impossible. Therefore, experts suggest that minimum 10% of your portfolio you have to invest in index funds when market is at lower stage, because at this stage you will get a fund units at lower NAVs. So start investing in index funds through SIP mode, systematic invest plan, at this stage, and in future whenever market falls, if it is possible to you, then invest as much as you can in your portfolio. Then after 15 years you will start gaining compounding investment benefit. So compounding investment benefit is one long-term strategy. In this strategy, you will reinvest interest or dividend of your fund in your portfolio. When you invest principal amount and returns amount in your fund, then you will get more mutual units. As a result of that, your investment will grow at an increased rate. So that is the benefit of compounding investment. And if you want to gain this benefit, then it is advisable to start investing in index funds as early as possible. Therefore, index funds are advisable to young people who have age in hands. So if you start at a young age, you can comfortably meet your long-term goals like pension plans, otherwise children education, etc. Third advantage is no individual bias. Assume that this is one actively managed fund. Then the fund manager changes the composition of portfolio according to his individual biases. It adds an element of risk to the fund. Some of the biases are anchoring, focusing on past instead of adapting to the changing market. Second one, irrational optimism, believing that good things happen to us and bad thing happens to others. Third, herding, copying the decisions of others. Then regret, keeping previous mistakes in mind in the way of taking new decisions. And last one is irrational risk taking, taking undue risk in one area while avoiding rational risk in another. On the other hand, index fund is free from all these personal biases of fund manager, because fund manager cannot design portfolio as per his own wish. He has to follow automated rule-based investment methodology by matching the fund portfolio with that of market index. Thus, the risk of loss due to the inefficient personal biases of fund manager is automatically removed. Fourth advantage is diversification. So the market index portfolio constitutes the stocks of well-established companies from different sectors, and invest fund portfolio also should contain the same company stocks. With a single investment, one index fund investor is able to get the benefit of diversified portfolio. As all these companies are financially proven, even though one or two companies fail to perform properly, it doesn't affect the fund portfolio significantly. Last advantage is easy to understand. In case of actively managed fund, you need to read, you need to understand why the fund manager is believing a particular sector or a particular stock, and why he is including that in the fund portfolio. But in case of index fund, it is very simple to understand the portfolio of an index fund. Simply, you have to know the market index which is followed by the index fund. So, if you are a new investor, if you don't know anything about stock market, you are interested in equities, but you don't want to monitor your fund regularly, in that case, index funds are suitable to you. So this is all about the advantages of index funds. Hope this video is informative. Thank you.